So what you see here is this is the S&P 500, and this is the 10-period moving average. So how interesting is this? That this precedes this. This precedes this. It's just really super interesting. What you really want to be looking at, though, is here. If you look at the moving average here, when the moving average is really, really low down in here, you can see this is all the action of tons of calls being bought. That's all calls. This is the put spike buying that kind of indicates it's coming. The puts are going to take over at some point, but not yet. A lot of calls. So when there's a lot of calls, the moving average is low. And that usually means that the market is rising, but coming up to a topping pattern in the S&P 500. When this gets a little toppy, everybody and their sister has calls. And so that usually means they move over to puts. And as this topping pattern comes to fruition, you get a pullback in the market. The markets pull back as more and more puts are bought until this gets extreme. When this gets to an extreme level where there's a ton of puts in the market and everybody and their sister is short, you get a bottoming pattern in the SPY. And that now the SPY is sort of ready to bounce and to rally. And as that rally begins, they start buying more calls again and they switch from puts to calls, and then this starts to move down as the market moves up until what? Until you get another extreme level where there's just so many calls in the market. When that happens, you get a pullback as they buy more puts.